A very good morning, good afternoon, and good evening to all. Myself, Vaibhav. In today's session of Visual JForex, we will be continuing our algorithmic development using the indicator Midpoint. This is going to be the third and final part of this series in which we will be completing the setup. So let us head to the Visual JForex board, which has been developed by the Dukascopy Bank SA. In last two sessions, we had seen how we can define and design the logical requirements for the execution of the trade in a profitable manner using this particular indicator. And as the name suggests, this is derived simply using the closing high and the closing low for any instrument of your choice. We had used these blocks, the logical blocks as well as the indicator blocks to define the conditions. And to look at the price volatility, we are also utilizing this historical candle block and calculation expressions on the lower side to define the variables which we will utilize while placing the conditions for the execution of the trade. And here the setup is complete for the sell side. So today we will be completing the buy side of the equation. This time around we are changing the convention. Usually what we do is complete the buy side first and after that we go for the sell side. But now in the last session we had completed the sell side, so today we will be working on the buy side of the algorithm. First I will change this to 4 hourly. Here we have this chart open for the Euro USD with the time frame of 4 hours each. We have to look for the conditions where we will have higher probability of ending the trade in a profitable manner. So what we are doing, we are looking for overbought and oversold scenarios on the time frame of 4 hours, and now we are going to simply limit ourselves with finding the opportunities in a overbought scenario as we are looking for the buy side only. So for that we will be taking the help of the midpoint valuations. If we see that the midpoint valuations have been falling for last 5 days, 5 days cover the trading sessions for the week, so we are utilizing these 24 hours 24 blocks of 4 hours each, so we get the data for last 120 hours which stand for last 5 days, and that means we have the price data for last 1 week. And if we see that over the last 5 days, if the underlying instrument has entered into a overbought sorry, not overbought, oversold scenario, so we will have some prospects of it retracing, and even if it is not going to change its trend, we are likely to see some sort of retracement happening, and even if it simply stays into a sideways momentum, we will still stand to gain. So to exploit that kind of situation, we can take the help of this midpoint indicator, and if we see that last 4 hours output value for the midpoint is lower compared to the midpoint output 5 days back, we can be quite sure that there has been substantial fall, substantial decline in the underlying instrument's valuation. And in such a scenario, what we will do, we will simply change the time frame to lower of 1 hour each, and here we will be looking for the data over last 24 hours. So we will be looking at the price formation over last 24 hours, and here we change the condition. Instead of looking for contrarian trade in a bearish environment, we wait for trend to change on our side. So on the lower time frame, we will wait it out and we will allow the trend to change on the bull side. So this time around we reverse the condition and we take last 1 hour's output value for the midpoint, and in last 24 hours it should have risen. So that means we compare the output value of the midpoint 24 hours back and it should have been risen. So using this condition we will be quite sure of the price rise, and we will be looking for some sort of reversal, and if not total turnaround, as I said earlier, we can bank on some retracement. So that's the logic. And along with that, we will also be taking into consideration the actual price volatility. If we have seen that there has been some correction in recent hours, in last few hours, and now again the price is picking up, so we can exploit that kind of scenario also, and to make sure that we have correction and then possible pickup in price, we will be also looking for last 2 to 3 hours of data. And only if we see that last hour's closing value is higher compared to the last hour's midpoint, whereas in the penultimate hour we had a total reversal of sort. In that hour, we will need the closing value to have been lower compared to the midpoint value for the penultimate hour. So we will be comparing last 2 hours data, and there should be the price rise, and only after that we will be going for the new trade. And our initiation point will be the closing value of last hour, and as and when the price starts to rise, we will be placing the order. And to define the stop loss and target price, we will be considering the last hour's closing value and the low over last 4 hours. We can define it multiple ways. And I think instead of going all the way back to 4 hours, we can even simply use the combination of last 2 hours and take the candle 20 seconds closing value and the low of candle 23rd. So we have this price difference, and whatever has been the price rise, we can simply take a particular ratio. I think even a ratio of 1:2 should be good enough, as we are dealing with the lower time frame. So we are not really expecting any big move to have happened within 2 hours. So I think looking at the ATR, generally the ATR for the 1 hour in Euro USD is around 14, not 14, around 10 pips, and we can be pretty sure that on most days that is going to be the case. So let us now get back to the defining of the conditions using these blocks on the Visual JForex platform. So first thing first, we will need to carry out 3 calculations to look at the price volatility, and once we are done with this, we will start placing the conditions using the logical blocks. So we take the difference between these two hourly candles. We take the closing value of the candle 22nd, which has the shift value of 1, and compare it to the low of candle 23rd, which has a look back period of 2, and you will have this difference utilized to define the stop loss and take profit. The calculation is going to be simple: A1 minus A2, and this will be the actual difference. So I'm going to define this newly created variable as AD1, and after that we have to be a bit careful while defining these new variables. This is in double data type, whereas we need the trade command block variables to be of integer data type. So that factor needs to be kept in mind. And to get that, I will get this multiplication done, and then wait for the trade command block to be included. It is going to be A1 into A2, and we will leave this output value field blank. Okay. So now we get back to the logical formation. Here, if I'm not wrong, I think we are going to need 7 of these. And after that, open at market. And as I had explained the conditions, the formation is quite simple. We are simply relying on the two different time frames where we are considering the formation over the last 5 days, as well as to make sure that our entry conditions are optimized. We are also considering the price formation of last 24 hours. And I'm going to now utilize these two output values, midpoint 13 and midpoint 17, to draw the comparison. And here we will need the midpoint 13 to be lower compared to the midpoint 17. So we have to define first input less than second input. And after that, we consider the price formation over last 24 hours. So we have to compare midpoint 18 and midpoint 19. Midpoint 18 needs to be higher compared to the midpoint 19. First input greater than second input. And to look at the price volatility, we are also taking the help of these get historical candles. I think here we have to compare the midpoint 19 and midpoint 20. With the closing values of these two candles, candle 22nd and candle 23rd. And prior to that, I have omitted one condition which we will need to add. We have to consider the difference between the midpoint 19 and midpoint 21. Midpoint 19 has a look back period of 1, whereas midpoint 21 has a look back period of 24. So we need midpoint 19 to be greater than midpoint 21. So I have to change these conditions which we had defined. Midpoint 19 is in place, and we have to get midpoint 21 here. We need midpoint 19 to be greater, so I have to invert this condition. Okay, and after that we get to the closing values of these two historical candles with the look back period of 1 and 2 respectively. So we need closing values for candle 22 and candle 23rd, which we will retrieve from auto created variables. Here it comes, and candle 23rd close is also added now. And these two values will need to be compared with the midpoint with similar shift values 1 and 2. So these are going to be compared with midpoint 19 and midpoint 20. Candle 22nd candle close needs to be higher compared to the midpoint 90. So first input greater than second input. And in the penultimate R, the closing value should have been lower. So we consider candle 23rd close and it should have been lower compared to the midpoint 20. Okay, so now we are mostly done with the conditions using these midpoint indicator. Now we turn to the price action data and see how the last 1 hour candle close is showing us. If it is greater compared to the opening value, that means there has been price rise. So we compare the closing and the opening values for candle 22. Okay, so again we have to go back to the auto created variables and retrieve the data. And here conditions is simple: first input greater than second input. And now all we have to do is look for the moment when price will start to rise above the last hour's closing value, and for that we are going to utilize 10-second data. And for that we will have to take help of these two 10-second candles with the shift value of 1 and 2 respectively, candle 24 and candle 25, and compare it to the last 1 hour closing value, which is candle 22, as all of you are now aware. So again we take this closing value here, and this is going to be the common input. So I have to take one more logical block, and here we have these two 10-second candles as well. So first input greater than second input, and after that we also consider the penultimate 10-second candle, and it should have closed lower. So we are done with these conditions now. First input less than second input. I will join it to multiple action. Now we turn to defining of the conditions, not conditions, the variables for this trade command block, the input parameters. This is going to be the buy trade command. Default instrument remains as it is. Trade amount is going to be changed to 0.1 million. Slippage is going to be 2 pips. Stop loss and target price is going to be dynamic. For that, I have to create a variable. I will name it SL1, and its value will be derived from this calculation which we had carried out earlier, and we multiply it by 2 and we get the take profit level. MLP is the multiplier. It has a value of 2, so this is going to be A1 into A2, and again new variable will be created, and is going to be TP1. Its value will be derived using this calculation expression. So with this we have defined all the conditions necessary for the execution of the buy trade, and with this the job is done from my side. Now you will have to replicate it on your platform, and once you are done with that, you can test it out on the historical data on the JForex platform for months or even years, and there you will get to see if the setup which we have designed and developed is profitable or not, and if any changes you want to carry out, you can always do that. So it's up to you. And to check out the further coverage of the market, you can check out the market page of the Dukascopy, and we are also available on the Facebook. You can join us there. Thank you all for joining in. Have a wonderful time ahead. See you next time. Till then, goodbye.